Today, I'll be asking our CEO and Chief Strategy Officers, Sam McGee and Robert Finch, a few questions that are on a lot of people's minds concerning the Fed and interest rates. Okay, let's get started. Sam, a lot of investors have concerns about inflation, the Fed raising rates, and what they may do to the economy. What would you tell the investors in a unique time like this?
That's a great question. So first off, I would say the Fed is doing their job. And the painful reality is when you're raising interest rates, it doesn't feel great because it's going to send, shockwaves through the economy and the stock market. However, what we learned from the 1970s, the late 1970s, early 80s, when Volcker was Fed chairman, was you have to raise interest rates in order to stymie inflation. Without that, I think the consequences would be a lot worse had we just, let that continue to ride. So I think the Fed is doing their job, and it's going to take time. It's going to take time for that to be able to do its work, to be able to bring down and tame inflation to a more normal level.
Okay, thank you for that. Switching gears to another related topic. There are a lot of employees across the country that have legacy pensions that have lump sum options tied to interest rates. What would you tell those that are nearly retired in times like these?
Yeah, so that's a difficult one to answer because as you pointed out, lump sum options on legacy pensions are tied to interest rates, meaning that if rates go higher, long-term rates, then typically lump sum values go down. Now, the reason that's a difficult thing to answer is because it's a very unique situation for each individual investor or client or those facing retirement decisions. So it's not binary, meaning if rates go up and pension values go down, that does not necessarily mean, gosh, I need to retire. And in fact, a lot of times there's a disconnect between what someone believes is a tie to that lump sum determining rate and what the Fed is doing. So when the Fed is raising those short-term rates, we can see sometimes, in fact, that the long-term rates may even come down or stay flat. And so over the course of the last year, we had a very upward shaped yield curve, meaning shorter, smaller interest rates on the short end of the curve and larger interest rates on the long end of the curve. And as the Fed has raised the short-term rate, it's actually flattened out. So surprisingly, interest rates on a long-term basis are still decently attractive historically, but it's a more complicated answer because it really depends on the individual.
That's a good point there. And I have one more question for us. And for the last question for today, this one's for you, Robert. What are some of the pros or benefits you see to this current environment? In other words, in a world where there are so many doom and gloom headlines, what bright spots do you see for investors now and ahead?
Yeah, so the thing that I would add on that is, interest rates are coming up, so that helps savings yields. It also helps bond rates to kind of normalize, which is exciting for fixed income investors, as things have been really low for a really long time. But I think on the equity side, the thing that's most exciting is with all the volatility presents opportunity. And so we are able to kind of get our hands on high quality businesses at more reasonable prices than we ever have been before, especially those that should be able to navigate through rising interest rates, inflationary environments, and recessions as they their valuations get more attractive.
Thank everybody who listened in on our piece today. And if you'd like to stay as up to date as possible with our videos, please subscribe down below. And if you want to stay up to date with